An awful lot has changed in 28 years for all of us, but the Reserve Bank Act has, for all intents and purposes, not altered at all. I believe 28 years on, it is the right time to examine its place in continuing to support the New Zealand economy and delivering for New Zealanders the quality of life they desire and deserve. It is true to say that at the time of the passing of our Reserve Bank Act, it was a world-leading piece of legislation. In particular, its single objective of price stability and the single decision maker in the form of the Reserve Bank Governor gave a sense of certainty that had been missing, particularly in the early part of the decade. I don't need to rehearse that period of political history for this audience, but suffice to say that the 7.6% inflation rate that was operating at the time the Act passed would have seemed like an oasis of calm to those used to volatile double-digit inflation through the late 1970s and early 1980s, and all of this driven, of course, by the vice-like grip of the accounting tarmacy on all aspects of the economy. As such, the Act was a creature of its time, but we now live in different times. In the wake of the global financial crisis, there has been a significant challenge to the effective operation of monetary policy globally. The mandate and tools so necessary to contain rampant inflation in the 70s and 80s have struggled to help economies resuscitate from the crisis. As Joseph Stiglitz has said, the crisis has brought home something that should have been recognised before the crisis. Managing inflation is not an end in itself, but a means to an end. The end is a more stable economy, not just price stability, but real stability, and an economy that is growing faster in a sustainable way. In New Zealand, the failure to meet the policy target agreement goal of the inflation band of 1 to 3% for 4 years has raised questions about whether monetary policy can make a decisive difference in the operation of the economy. Over the term of the current governor, inflation has averaged under 1%, and even on the Reserve Bank's preferred core inflation measure, only just over 1%. Meanwhile, our currency has stayed at what the current government has described as too high and unsustainable levels, and hundreds of thousands of New Zealanders remain out of work. I'm not for a moment suggesting that any central bank is capable of dealing with all of the ills of or creating all of the opportunities in the economy. What is needed, in my view, is the best possible alignment between fiscal policy and monetary policy. The Reserve Bank itself has stated that monetary policy requires fiscal policy freeze in order to deliver its aims. The Secretary to the Treasury said this best recently when he stated, "Relying on monetary policy alone to do that job risks the longer-term growth potential of the economy by leading to the misallocation of resources towards investments, such as residential investment, that are comparatively less productive in terms of generating wealth and well-paid jobs." Given the length of time since the Reserve Bank Act and the increasing questions about the effectiveness of monetary policy, I believe the time is right for a review. This is not only from a policy point of view, but also as the incoming government will need to appoint a new governor. Let me be clear. We wish to undertake a review alongside the bank and to look at the measures and tools the bank uses. This would include looking at the way inflation is measured and the adequacy and appropriateness of the tools that the bank has at its disposal. This level of review of operational matters can only be done in cooperation with the bank. But I think, in the interest of certainty and transparency, that I should outline our thinking on some core legislative matters in advance of any review. A review would represent an opportunity for a reset to a modern monetary policy. From a Labour Party perspective, a refreshed approach would be founded on the view that we must protect the independence of the bank while giving monetary policy the chance to play its fullest part in meeting the economic goals of the country. As a government, it is our job to be clear on the goals we have for the economy and to provide all parts of the economic apparatus, including decision makers such as the Reserve Bank, the tools to focus on the delivery of these goals. There are many areas to cover in what constitutes a modern monetary policy approach, but in the limited time we have today, I want to focus on two proposed changes to the Reserve Bank Act. The first is a broadening of the objective of the bank from just price stability to include also a commitment to full employment. It is important for New Zealanders that we control inflation. We have seen the damage that out-of-control inflation can do to our economy and to our citizens. It is our most vulnerable who are the most affected by rising prices. The most recent data from Stats New Zealand shows that our senior citizens have faced a 50% higher inflation rate than average in the last 9 years. The lowest income quintile has seen inflation nearly a third higher than average, and yet the highest income quintile has seen inflation increase nearly 25% less than average. It is therefore right that we should continue to have price stability as a focus of monetary policy. It is our intention that the current inflation target band in the Policy Targets Agreement would be maintained. But the next Labour government is also determined to focus on the creation of decent work with high wages. This should be no surprise to anyone. It is in the very DNA of our party. Our policy platform calls for us to work towards full employment. One of Andrew Little's first commitments as Labour leader was for us to reduce unemployment to 4% in our first term. Having 140,000 people unemployed, 44,000 of whom have been so for more than 6 months, will never be acceptable to me as a Labour Finance Minister, and nor do I think it would be acceptable to many New Zealanders. There are, of course, a range of policy measures that we will take to support this goal. And I should mention at this point that only a couple of weeks ago, Labour and the Green parties released a set of budget responsibility rules that represent a fiscal bookend to this monetary policy speech. On fiscal matters, we will be responsible and we will deliver transformative policies. As the most recent Labour government showed, we can run surpluses, pay down debt, invest in the long term, and achieve far-reaching social change. In the next Labour government, might get a governor ringing you, Grant. In the next Labour government, these will be driven by a substantial focus on regional development, skills and training, investment in research and development, and changing the rules of government procurement, to name just a few. But monetary policy can play its part too. The idea of including a reference to employment outcomes in the objectives of the central bank is not unusual. A number of countries, such as the US and Australia, have either a dual or a mixed mandate for their central bank. Nor should it be assumed that having a dual or mixed mandate degrades the other objective of controlling inflation. Eric Rosengren, the Chief Executive of the Federal Reserve Bank of Boston, has undertaken a study to compare the inflation outcomes of the US as a dual mandate country and a range of single mandate countries. His research shows that over the past 15 to 20 years, the US performed better than or as well as the single mandate countries in controlling inflation. The current Governor of the Reserve Bank has made clear that employment outcomes and other measures of the health of the economy are considered by him when making decisions. If that is so, then there is little to fear by changing the objective. My view is that by legislating into the mandate of the bank a focus on full employment, this will give the labour market an appropriate weighting in decision making. It also means that the bank can be held accountable for keeping interest rates artificially high during periods of low inflation and high unemployment, as we have seen recently. As Peter Redwood has recently noted, had a mandate to maintain full employment been in operation in New Zealand, it is likely that it would have constrained the bank's aborted tightening of the OCR in 2009 and 2014. And this would have in turn hopefully seen a faster return to target inflation and faster economic growth. Placing full employment is also not about virtue signalling, as Michael has catchily termed it. We are in fact serious about setting objectives for the bank that are long-term and provide the right signals and incentives to the Reserve Bank. The danger of not doing so can be seen around the world. In the UK during the 1990s, the then Chancellor of the Exchequer stated that rising unemployment was, quote, the price that we have to pay to get inflation down, and that price is well worth paying. Unemployment at the time was rising towards 2.5 million, and retail price inflation was 4.5%. The ECB in 2012, with a single price stability mandate, increased interest rates. Inflation in the area was rising and was 2.7%. Unemployment in the area was 10% in the general population and rose to 12% after the announcement of a rate change. As the Wall Street Journal editorial said at the time, the European Central Bank's single mandate to achieve price stability and to focus on nothing else is often criticised for being a handcuff that prevents the ECB from being proactive during swings in the economic cycle. A look back at the last 6 years of business conditions data clearly shows that those critics are onto something. In the words of Paul Krugman, central banks and policymakers will be making a terrible mistake if they look at low, stable inflation rates and pat themselves on the back for a job well done. Low, stable inflation can, in fact, be entirely consistent with catastrophic economic management. Ladies and gentlemen, a dual mandate provides a means by which a government can signal that low inflation alone does not just signal a job well done in its entirety. An economy characterised by low inflation and full employment should and is the goal of any responsible government. Full employment is the manifestation of sustainable economic growth in the economy, and therefore it is appropriate for it to be an objective for the Reserve Bank as a core actor in the economy. There are, of course, a variety of definitions of full employment and a number of variables that impact on it, such as labour force participation. The exact operation of this objective would, of course, be subject to the negotiation of the new policy targets agreement, but it is not our intention to seek a specific numerical target. The second area I want to focus on today is the decision-making processes of the bank, and particularly around the official cash rate. I am proposing a change to the decision-making process of the bank so that the committee, including external appointees, will have responsibility for setting the OCR. The committee will publish the minutes of its decision within 3 weeks, including noting any dissenting views. While the single decision-maker role for the governor could be seen as an effective accountability mechanism, it is out of step with international practice. Also, with the expansion of the objective highlighted above and the increasing complexity of financial markets, the role is not one that I am comfortable vesting in one person. This is no reflection on the current governor or indeed on any previous one. As the Reserve Bank itself has said, quote, a group of individuals with a diverse and different set of useful information should make generally more informed decisions than an individual. In 2012, at the time of the appointment of the current governor, the Treasury told the Minister of Finance that they saw benefits in pursuing a committee structure and noted that discussions with private economists favoured it as well. In some senses, this has already been recognised by the current governor. In 2013, he formed a governing committee, including the 2 deputy governors and the assistant governor. He's made clear that while he maintains statutory responsibility for decision making, the committee has in effect taken on the role of setting the official cash rate. This proposal seeks to build on that approach. We propose that the 4 governing committee members be joined by 3 independent experts. The appointment of the experts would be in the hands of the governor after consultation with the Minister of Finance. The appointments would also be subject to select committee scrutiny through the Finance and Expenditure Committee review of the bank. We are proposing a Treasury official would attend the committee without voting rights to provide a vital link to fiscal policy matters and intentions. Again, this approach is not unusual around the world. It's closest in its operation to the United Kingdom model, but in Australia and Europe, similar models are in operation. I don't intend today to name individuals who I believe could fulfil these roles, mostly to protect the innocent. However, I am more than comfortable that there are capable people with expertise that we need in academia, the public and private sectors, and the non-governmental sector, including former board members who could undertake this role. We will be seeking to have a range of perspectives represented, reflected both of the importance of the decision that the bank makes and indeed the broadened objective that we have proposed. We will be asking those who undertake these roles to make a significant time commitment. To give an indication of this, in the current process used by the bank, there is effectively a 9-day program every setting cycle. I would expect anyone involved in the committee to make a full-time commitment over that period, in addition to other regular discussions and meetings. We will also be asking members of the committee to sign a non-disclosure agreement, meaning that they could not talk publicly about their decisions or make comment about future decisions without the express permission of the governor. We believe adding outside expertise and perspectives will enhance public confidence in the decision-making process. In addition, to help sustain confidence in the system, greater transparency would accompany a change to the decision-making arrangements. We are proposing putting the minutes of each meeting of the committee online within 3 weeks, including the result of any vote. This is done in a number of other jurisdictions, including the United Kingdom and Australia. This would give greater certainty to markets about the trajectory of decision making by the bank. It is also important for a public institution making as important decisions as the Reserve Bank does, but that does not answer to an elected official to have that level of transparency. Reserve Bank staff would continue to prepare projections and financial information for the committee. The Reserve Bank board would still have retrospective oversight of committee decisions and would hold the committee and the governor to account for any systemic errors or omissions. The Minister of Finance would retain all powers reserved for them under the Reserve Bank Act. Ladies and gentlemen, monetary policy is a complex topic and one where certainty and consistency are virtues. But it is also not written by Moses on a stone tablet. Like all areas of policy, it needs to be reconsidered from time to time to reflect the principles and practices of good economic management, the changing environment in which we live and work, and the way it relates to other parts of the economy. Now is the right time to do that, for both policy and practical reasons. I look forward to engaging with all those who are interested to shape our modern monetary policy so that it can play its part in the development of a New Zealand economy that delivers sustainable and shared prosperity. Thank you for coming.